Bitcoin has been called a currency, a store of value, and even digital gold. But is Bitcoin really a hedge against inflation? To answer, we first need to understand what inflation is. Inflation measures how quickly prices rise, reducing money's purchasing power. Traditionally, investors look to gold to protect their wealth during inflation, as it is scarce and has been a store of value for centuries. Bitcoin shares an important similarity with gold: scarcity. Its total supply is capped at 21 million coins, unchangeable by authorities. This fixed supply is a highlight of Bitcoin's inflation hedging feature. Unlike fiat currencies, Bitcoin's issuance schedule is predetermined. But scarcity alone does not ensure it acts as a hedge. The key is whether an asset moves oppositely to inflation to protect investors. Looking at the data, Bitcoin's performance has been mixed in high inflation periods, sometimes rallying like gold, sometimes falling as a risk asset. When inflation rises, central banks typically respond by raising interest rates, which strengthens currency and makes risk assets less attractive. Bitcoin has often reacted negatively to these rate hikes, similar to stocks, indicating it may not behave like a pure inflation hedge in the short term. However, the long-term perspective differs. Over its history, Bitcoin has outperformed inflation, with gains above the rise in consumer prices. This suggests that despite short-term volatility, Bitcoin might still act as a long-term store of value, like gold over decades. For more insights into Bitcoin, inflation, and the macro forces shaping crypto, stay tuned here on Blockchain Reaction. Like, follow, and keep learning.